I mean, Stephen, it's just 2 days ago when the JSE opened at around 38,000 points or so. Now we're looking at it back above 43,000 points. I mean, worst is over, or is this a dead cat bounce?
Yeah, so perhaps it's useful for me to start by admitting that I couldn't be more confused with the situation. Suffice to say, the world is in crisis. We're seeing GDP contractions right across the board, including the US, which is expected to be down about 30 to 50%. And yet we're seeing market moves to the positive that have last been seen in 1933. So a great day yesterday, another great day today, and it's largely off the back of stimulus measures. Personally, I think the scale of the stimulus measures are probably unprecedented. So we're seeing the mammoth $2 trillion stimulus package announced by the US, which currently sits in bill form. But if the vote goes according to plan, could soon be signed into law. And it's got the market salivating. But I suppose the true test is going to be whether people that unfortunately around the world are isolated and losing incomes, whether it can be sufficient to allow them to continue to pay their bills, and perhaps equally important, to spend and continue spending. I don't think monetary policy alone is going to be able to do that.
I mean, I agree with you, and someone else who agrees with you, Ben Bernanke, the former US Fed chair, speaking with my colleagues at CNBC International, saying that monetary policy and even fiscal policy alone might not be the cure here, especially if, you know, it doesn't trickle down effectively to solving the problem, the real problem here, which is the health system. But I want to speak with you about something that is also unprecedented, Stephen, for many, and this is the latest moves coming out of the South African Reserve Bank. I mean, is this quantitative easing? What do you make of the extra intervention that the SARB has announced today, and the impact that it will have for South Africa's economy?
Yeah, so I think unmistakably it certainly is stimulus. So stimulus, quantitative easing is probably a term used quite loosely. But in essence, what central banks around the world, including the South African Reserve Bank, are doing is trying to ease the liquidity constraints that are clearly evident across markets, some more prevalent in markets. We're seeing the European Union mulling over the European Stability Mechanism at present. We also know they're actively engaging in market to create more liquidity and ease strain. The $2 trillion stimulus package in the US will essentially perhaps be a little bit more direct a mechanism, but again motivated for the exact same reasons. And finally, the South African Reserve Bank, for a lesser extent, engaging in direct bond buying in the secondary market in South Africa. All necessary measures, I believe.
Right. Stephen, I mean, you started the conversation saying that you're quite confused at what is going on now across the markets, but there is a lot of buying going on. And the question is, for you, what are you advising clients about what to buy, given that things have come off so much and many stocks are trading at a significant discount to their net asset values?
You know, so I suppose the first bit of advice that's probably warranted is to pause. It's very difficult, given the volatility in the market, to not get swept up in the market hysteria. I think the first bit of advice is not to try and catch a falling knife. Just to put it in context, how severe the crash has been over the last 3 weeks. The declines that we saw in the last 3 weeks globally really took about 4.5 months during 2008 to reach the same scale. So it is very aggressive selling. It feels a bit like an avalanche when it comes at you. But what we've seen in the last 2 days is global markets up almost 20% in 2 days, which again is rather dangerous if you time it incorrectly. So I think for those that can't afford short-term losses, the advice would certainly be to sit on your hands. Cash is probably not a bad position to be in until we see some sort of normality in the market. But for those with the luxury of a bit of a long-term view, I think it's undeniable that we're seeing value come through in the market that we've been waiting for years to see. Financial services, for example, are a good standout. We see some of the banks today, Standard Bank, Nedbank, trading at price-to-book values of less than 1. In fact, in the case of Nedbank, it currently trades at a price-to-book of 0.5. and it's declined over 60% over the last 12 months. So you can't argue the value case for our financial service providers.